people that didn't stall during Fed hikes and recessions, that they kept investing with adjusted expectations. These are the times you don't stop investing, but you find good people. People say, well, how much skin do you have in the game? And I'm like, 100%. If you really are playing it straight down the tax rail, guys are making...
Investors and operators, welcome to the Invest Clearly podcast. We have real conversations with passive investors and real estate sponsors. We go beyond the pitch deck to explore how trust is built, how capital is deployed, and what's driving decision-making on both sides of the private investment ecosystem. These aren't highlight reels. They're honest conversations about strategy, performance, and lessons learned. Whether you're an LP, GP, or somewhere in between, this is where transparency in the private market starts. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Judd, thanks so much for joining me.
Thank you. Great to be here. Thanks, Joe.
Yeah, really looking forward to our conversation. We got to know each other a little bit, but I want to give you an opportunity before we get started for our listeners who might not be familiar with you. Would love to just, give the 90-second version about yourself and DWG, if you wouldn't mind.
Oh, thank you so much. My name is Judd Dunning. I am the owner of DWG Capital Group and DWG Capital Partners, as well as American Industrial Machining Partners, which is a private equity arm. We're a conglomerate of an American post-institutional boutique brokerage that also has an investment wing. I'm here as for the investment wing. It's what we do mostly, but I still have that company. Sure. And we have 100 million AUM in industrial sale leasebacks across the nation, a few business holdings and a few multifamily holdings, but we are 95% an industrial triple net sale leaseback shop. We have about 400 investors, a mixture of some family offices, a few international investment groups, a few syndicated investor groups, and a lot of H&W investors.
Awesome. So what drew you to industrial sale leaseback? I'm curious.
It's interesting. It came. We were talking before the show, and quickly, I had started 22 years ago. I'm from a fourth generation real estate family. And when I first got in the business, I was actually in film finance. So I started doing real estate syndications and in triple net malls throughout Florida being developed. Walgreens or Publix was the star. The developer was the director. The subtenants were the actors. It was a very similar issue. And it just took off. I did 7 in a year. It was 2004, that period of time in Florida, which part of my family's from. We're from North Carolina, Florida, Colorado, and we're back east family, but I've been out in Colorado and now California for 30 years and now Texas. So I've been all over the United States. And so I was putting together groups of like Israeli investors and Southern gentlemen and H&W families. And immediately I came out of the box doing these syndicated assets. And I was Rookie of the Year. Then I was scouted by Sperry, and then I started doing across the nation. I started doing Wendy's and Home Depots and malls. I've done $2 billion of real estate, and that I personally closed, maybe coming up on $2.5 billion now. So I've been around for a while, and then Newmark scouted me, and I started working on distressed loans, and I became an FDIC broker. And so then I started doing debt, equity, bifurcation of distressed assets, workouts, and the banks would hire us, and they'd say, "Hey, solve these 15 assets." So I ended up being the founder of West Los Angeles Newmark Capital Markets. We went from like 10th or 12th, now like third in the world through the biggest IPO a few years ago. And then I turned 50, gave myself a raise, opened my own post-institutional brokerage, and then went into industrial. And just on a quick note, we just did the Sony Animation Studios, like $165 million on the brokerage side. That was an industrial flex deal. We won the Los Angeles Business Journal's award for Deal of the Year. And, I established myself post-institutionally. And so once I had that benchmark leaving the institutions, the perfect intersection for industrial sale leasebacks was debt, knowing the nation across the nation, being able to underwrite businesses, being able to do joint ventures and create that perfect arbitrage. Because you have to underwrite the business itself, the property itself. You have to go across the nation when the mergers and acquisitions and private equity happen. So you have to have that, Americans backing America understanding of complexity. And I thrive in complexity. And so Also, last point, I mean, industrial has been an amazing sector. We can talk more about that.
Yeah, I would like to dig into that a little bit. But before we go there, so you're working with like pretty sophisticated deal structures, institutional level underwriting. How are you breaking down that complexity to make it clear for investors so they feel confident?
Well, yeah, it's great. Well, so I was saying, if you can't sell it on the page, you can't sell it on the stage. That's part of my brokerage. So if you get the cover of any of my deals, I tell you, I call it a senior advisory note session. I tell people exactly what they're buying. You know, transparency, transparency, transparency. There's 3 rules, that my dad said is never do a deal you wouldn't do in a handshake. Always leave a little on the table for the other guy, right? And then take the high road no matter what. So if you have no secrets, if you have no shadows, right? If you're completely transparent, one, life is easier and you're in Judeo-Christian compliance and integrity. But 2, it's also constitutionalism, right? So I'm kind of, an older pedantic like person. I think about every time we do these deals, we're transferring, we're giving people more time through cash flow for, God, nature, and family. And so it's really personal what we do, and really, we have real passion for that.
Got it. So that's really great that's where you're coming at it from. So it sounds like transparency is kind of the philosophy around building trust.
Right.
It's still like a niche asset though.
It's,
do you find when you're able to simplify it, kind of like the cover page, if you can't sell it on the page, how are you simplifying it? Like, do we have trouble sometimes communicating?
Back to that, because I got into theory, which makes me happy. Because I
like theory a lot.
Yeah. No, I just love, creating results for individuals now. It's a lot of fun. We work for Goldman, we work for Chase. Now we get to work for friends, family, and colleagues. So, on a theory level, which you're talking about, as far as simplifying the deal, here's the bottom line in industrial sale leasebacks. So I go out because I have 14,000 lenders. And I'm a debt broker. I create the best loan you can get, 70, 75%, the very lowest rate, nationals, mid-levels, regionals, and we create the very best debt. Then from the debt, we know where we can negotiate our cap rates relative to risk. And then there, X basis points, a couple hundred basis points above, you can usually give people a 7 to 8 current pay, 8 pref, 17 to 22 IRR, 2X MOIC with amazing cost seg, right? So we call our bucket the nearly add value bucket. So, for people to step in, then we have to go hire credit risk analysis. We have to hire, accountants. There's 3 things. There's property, right? There's product, what you're buying, essential properties, essential product lines. And then there's people. People's the hardest one. Because, these operators, a lot of baby boomers are leaving the sector. A good example is we bought something. The guy's like, yeah, I'm going to hold it forever. My son. And they're like, no, then next year he's selling it. So we actually brought in a new CEO. And now we are buying part of the business into the business to stabilize the assets. So, there's a complexity there that we get to bring forward for our clients to protect them. So once again, back to the cover page, if people come to work with us, I like to say we make it fun. We're Americans backing American small to mid-cap businesses. And we do it through structured finance, but they get to just through the click of the mouse to the office of the house. Great, I want that cash flow. Great, I want that MOIC. Great, I trust Judd Dunning's analysis and the team. So you really do have to simplify the space.
That's pretty serious involvement with the business. So you do the lease back, guy changes his mind. Hey, my kid doesn't want to be in the business. We're ready to sell. And you actually step in and help place a CEO so that the business keeps going.
No, I just use that as an anomaly.
It's an amazing anomaly though.
Yeah. Cause what you've got to have that depth. If you're going to do single tenant industrial, you've got to dig deep, right? But what do you get for that? If you find a good sponsor, like every deal we do in that space, Joe, it's personal. It's 100. People say, well, how much skin do you have in the game? And I'm like 100% because I'm signing the loans. Yeah. It's personally guaranteed loan. And we have one tenant out of like 17 that we're repositioning, but we bought it in an urban infill market that we bought it, exceptionally, got like an 8.5 cap in Phoenix. It's a 5.85 to 6 cap market. So you never want to see a tenant leave. Usually you want to see another company buy them and then your cap rate compresses and the value goes up. But you do want to have a good team you play in the space that, is able to lease a site, et cetera. So because I'm a leasing broker, because I'm a debt broker, because I'm an equity and sale broker prior, I still have a team. I think we're uniquely positioned to protect and prosper our investors.
Yeah, it's really interesting. So obviously there's been a lot of movement in the space, on commercial, specifically in the past couple of years. Like it's been tested, debt, cap rates, valuations moving. Has that adjusted the way that you communicate to investors?
Yeah, no, definitively. I mean, the way that I think the key element that when we communicate to our investors is that, Morgan Hauser said something fantastic in The Psychology of Money. He said that we have the stats now that the average investor who invests through the storm continually. So the average investor that invests, like we can now look back, there's a 30% increase in net worth by the time that we end up getting to retirement for people that didn't stall during Fed hikes and recessions, that they kept investing with adjusted expectations. So that's a really important fact because we didn't have that kind of statistics. We didn't have democratized high net worth people making their own decisions. It was either mom and pops or institutional investments. Now we have this whole midline of, this beautiful partnership between America's democratized investing. Really cool. I mean, there's two things happening at the same time. If I can get a little theoretical, is you have BlackRock, Blackstone, Vanguard, and State Street. They're buying up America, but they're not monopolizing because they're micro-monopolizing 10 different companies. But really, America's being swept up into a mega monopoly that's broken into all these pieces. And the investors have reacted, smart people like you and I and the people hopefully watching your show here. And they're like, hey, you know what? I'm going to skip that. I'm going to go right to these mid-level GPs myself, not BlackRock, and make these decisions. And that's why Invest Clearly, obviously, exists. So you guys are also a force in that space. So what I've told people is like, hey, the Fed may be going crazy, but let's do this. Here's what I would give to those investors. I'd say, let's put in some reserves. We know that the Fed, after its peak, goes down 190 basis points historically from a peak. So we're going to use a refinance assumption of about 200 basis points out here. We may or may not get it, but I'm not going to make any cash flow until the refinance. But let's keep investing together. Let's keep moving. Let's buy at a lower basis and a higher cap rate when everybody else isn't, because we're smart. That is the most important communication to your point, right? I hope I took a long route to get there, but it's a very important point is these are the times you don't stop investing, but you don't freeze up, but you find good people and you buy low basis, high cap rates. Don't worry as much about cash flow. And then you get into the game. So I think that was our big thing. Like my first debt when I opened the platform 2.5 years ago before we bought 100 million was 3.37. My highest debt is 7.15.
Right. So if I net that out a little bit, it's basically, I think if we look back over the past handful of years, the communication strategy, if you were to look broadly in the space, like the Reg D space, there was a little bit more of a, financial freedom extremely quickly bent, that's putting it maybe too kindly. Get rich quick, maybe that's putting it too bluntly. What you're saying is like, hey guys, this is about the long term. Like just because things aren't as rosy as they were a couple of years ago doesn't mean we should stop. In fact, we can get deals maybe at higher cap rates. We'll be better off. We're going to position ourselves for a refinance and a cap rate compression down the road. And, that's what's going to build your long-term wealth. Is that?
Yeah, absolutely. Keep moving, keep plodding along. But I will tell you, there's a flip side of that for GPs. I mean, this is the transparency show, right? And that's the only way we are. The flip side for that is, for us to deliver financeable deals at the preferential expectations of a lot of these, the GP middle markets. I mean, the HNW democratized middle markets. I mean, I basically given most of the yield to the money.
Right.
That's okay. It's an honor and a pleasure, and we'll continue to build. We've done 100 million. We want to do a $500 million within the next I'm 58. So I think by the next few years, we like to take it further. But it's an honor to have their trust. But I will say that the LPs are making the majority of the money when rates are high.
Yeah, it's lean. It's lean on the GP side. Well, I think it's fair to share that, right? I think that's one of the things that maybe it seems like a lot of GP marketing is like aspirational, but it's good for people to know that you're really working for their money for a future benefit, I think, on the GP side. So that's good. I'm sure how much do you give in terms of financials? Like with your LPs, like how much access do they have to kind of financial data on the deals?
The sale leaseback, we have a team that has worked at Ansel Gordon, Stag, Store, and VRE. We have an institutional team that works for a bigger company that I actually still portfolio manage with. And I just don't sleep. So we pay a very discounted rate and have access to do an analysis. So we'll give them the credit report. It doesn't make, like if you take business financials, first thing you have to do is do redactions and add backs, figure out EBITDAs, rent coverage ratios, debt to income ratios. To underwrite businesses is the calculus of finance. And then to underwrite that and to debt and to real estate, is even farther. So we'll give them like with a snapshot, we'll give them a very detailed summary, but it wouldn't make sense for them to go into the trailing pre-M&A merger financials, the post financial. Sure. So we summarize that, but we will give them a credit report analysis that goes out with everything. And that's like $50,000 dollars just to generate that.
Got it. Yeah, that's interesting.
This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster.
So you've talked a lot, well, correct me if I'm wrong on this, but buying below replacement costs and targeting asymmetric risk. Can you tell me a little bit more about that and how that goes into your communication strategy?
Yeah, well, pretty much. I mean, I think the key to industrial is really driven by founders. So we have to, we'll take risk in tertiary areas because there's credit, right? So, but a key element is you want vacant defensibility and you want the ability to, to release the site. So the rents can be at market, but you can't overbake the rents, right? They can be at market, you can take risk, but you can't overbake. That's number one. You don't want to set yourself up for, serious issues, right? But the key element too is right now, it's a really interesting time because there's been so much, and this is, I think, what costs segregated accelerated depreciation is about also is like the cost went so high, right, that you can accelerate this depreciation. There's been all these changes in the market. We're buying things at 40% of what you could build them for, 50% of what you could build them for. So on a fundamental level, that's great, So that's the first element that buying below replacement costs with defensible rents is important. Now you balance that because you're getting above market rates. You balance that with the credit. So that equation is how tertiary is okay with credit. Kind of the magic of that is because it doesn't matter if it's in the middle of nowhere. If it's a good business, another big business is going to buy it. There's this huge wave of aggregation out there. So we're really creating these American business mid cap, small cap bonds. It's not just real estate. So there's two sides to it. So buy below replacement cost, buying locations. But if you're going to go more tertiary, make sure you're buying something that is like a good credit bond. So it doesn't matter as much where it is because you are still buying American industrial in America, run mostly by Americans, and we're a pretty powerful country.
Got it. I love it. I love I love investing in America. So let's scoot back to the concept. I know you've given me one really good story on like when something didn't go as planned. But maybe just we'll stick in the philosophical realm. Like when something doesn't go as planned, right? Something's delayed, financing shifts and issues. What does transparency look like for you guys? Like how do you communicate that? When do you communicate it? You know, I think there's one of the things I've been playing with a little bit on these shows is, you know, balancing under communication with over communication. Like what's your philosophy on what they need to hear?
Well, it's a great question because, you know, we've had one exit, but we started 2.5 years ago, 100 million, right? We got one exit and we've had like 7 credit enhancements. So we just did this thing called a week of wins. And, you know, there's negative and positive bias, right? So what you want to do is you go through different elements on assets, right? You also don't want to worry people if they've got their investment. I think it's like a parent or a husband, you know? It's like you don't want to come home and go, honey, the world is, you know, traumatize people. If I'm a pretty good real estate executive, so until there's a real issue, you don't want to come to them. So as of now, we haven't had any real issues. So I would say that, but in the highs and lows, we do quarterly and annual reports, and we scan through the assets and we talk about everything. We talk about all of them, but I really also think people forget all the positives. Hey, just went through an escalation. Hey, we were at, you know, $100 million, and now we have $500 million of sales because they got bought by another company. So I'd say there's 2 sides to this. I don't mean hedging around this, but I think if it's easy to deliver like worry news, and it's easy, which we do, but it's also important to put out positive news because negative bias. If you hear one negative, and this is for all the GPs you represent, people will, you know, run to set. You need 17 positives for every negative.
Sure.
So if we're out there working hundreds of hours a month, you know, to like make sure we're making every element go. If a guy doesn't pay his rent like for 7 days because of an accounting issue, I'm not going to send the whistle. I'm going to wait through cycle by cycle by cycle. So I think it's important to balance positive and negatives. But if you do have a real issue, I think it's important as soon as you think distributions could be suspended, you should be proactive.
Yeah, without a doubt. Okay, that's really good. So want to think about a little bit. You've got an interesting background, right? So you've got sales and institutional experience. Like, what have you learned about building trust with high net worth? And let's focus on the kind of high net worth avatar, because that's the audience. You know, I'm sure there are plenty of institutions and family offices that see Invest Clearly and listen to the podcast, but really it's individual LPs that are the target of this show. So what have you learned about building lasting relationships with LPs? Well,
the most important thing is you're really grateful for them because institutions are slow, you know, and they're difficult. So they've really created an amazing. So first of all, I just see them all as individual partners with the greatest of gratitude. Unfortunately, the company starts to grow where the personal connection gets separated from the CEO and the IR. So I'm actually doing something. We're launching it right now. We're leaving in a few hours. Called after 2 years, we're doing this thing called the Industrious Tour, which is our one-off deals. And then I have the Great American Industrial Fund, which is another $100 million fund, $35 million that we're capitalizing right now that we're just launching. And I'm not going to bring in my individuals, and it relates to the individuals here. I'm not going to bring in my individuals till I'm seated with my first institutional check, because I want them to have momentum and, you know, I want them to have space and trust. You have to treat them a little differently. Like, let them come in second. Don't build your fund on the back of your investors. Build your fund. Let them benefit from the fruit. So that's my theory. And then, and then on the industrious side, there's a lot of people, because they think that funds lose control, that the individual investors is talking about building trust, that the fund itself, that they're buried in fees, et cetera. That's actually not true. What you're doing is you're diversifying risk to protect everybody. But the H&W crowd tends to think, no, I want to make every decision by decision. There comes a point where the fund is a blessing to them to quiet the noise, to simplify their taxes, and to diversify risk for the LP and the GP. So we're in that transition. So I'm doing a dinner with 23 people tomorrow night in Fremont, and then I just bought a ticket for the year unlimited. So now we're doing we're going to do like 10 more dinners across the nation because we've reached a point where I think it's really important to be personal and get to know them, for them to see your face. So I'm at that moment where I felt like I don't know a lot of people that are investing with me personally. So the first thing is a company should never get too big that there's not stockholders meetings. It should be as equal a priority. I'm an emerging manager, so I'm just crossing that threshold. Emerging manager, yes, right? But at the same time, I got $2 billion in my tank, $100 million fund ahead of us, and $100 million done. So I think we're in a good position. But I think personally connecting, and then to go a little farther, because that happens to be exactly where we are today. I think it's very important for them to be able to call in and be heard, but at the same time know that we have to time block that, because the most important thing is the next acquisition. Right. Companies thrive by a wheel of income, so it's a balance. Is like setting up expectations. Call me anytime. And then at the same time, go further. So 131,000 square feet, 8.75 cap, 23-year lease by St. Louis is closing right now. We're really excited about that deal.
Nice. That's great. That's a good plug in the podcast right there. We're closing deals while we're doing podcasts. Well, it's to your point though. I mean, this is a struggle. So a lot of groups have started doing, I work with a lot of different groups and they've started doing more of these in-person events. I think it's critical. I think especially at a time where like so much communication, there's a lot of noise in the space right now around like automation and use more automated communications. I actually think that's like completely the wrong way to go for GPs, because this is still a people business. So it's good to hear you're getting out there, doing the face-to-face. I think that'll likely bear a lot of fruit. All right. Well, so in addition to that, I'd love to just understand a little bit more. So I was going to ask you, what are the plans over the next 12 to 18 months? But I guess I know now. So you're launching a $100 million fund. When is that going live?
It's like right now, actually. Pretty excited about that. We're just taking that out. And it's interesting moment because, you have to, launching a fund's interesting because you have to go after a really big tranche at once, because you got to tee up the deals, and then you work in the equity. And I'm not kidding, man. I probably put in like 100 hours in the last 12 days. It's been a lot of work, but we actually worked with these guys' fund launch, and love those guys because I had access the whole time to just like X dollars. I won't say exactly because I'm sure they have their own platform. But I've been able to call like top fund managers all over the United States and say, hey, is this fair? Is this equitable? Is this market? And make sure that I'm also walking in step with what H&Ws are looking for. And I'm triple checking my work because, it's interesting because you don't know if you're going to succeed as an agent until you jump into the abyss. You don't know if you're going to succeed as a broker. You don't know if you're going to succeed as an institutionalist. You're not in the institutional field. You don't know if you're going to succeed as a sponsor. You don't know if you're going to succeed and as a fund. Like every moment you step into the abyss, right? It's like no safety net, no ceiling, free market capitalism rocks. That's what we say, right? But so far, we're really grateful. And if any of my folks watch this, we're really grateful. It's such an honor to have people's trust to build through the storm because, man, those 12 to 14 Fed raises during our launching period, and to have people say, hey, you know what, Judd Dunning, I trust your theory, I trust your experience to come along with has meant a lot to us. And we look forward to going a lot further. So $100 million fund, but in the meantime, we are going to continue to do one-off deals. And we do have a couple investments in American Industrial Machining Partners that's going live today. And that's a little higher money. That's like 18% bridge investment capital for 12, 24, 36 months. And then what we give our guys is about a 7% plus current pay, 8% pref, and then a 17 to 22 MOIC, 2x MOIC but our cost seg, I have to say, let's talk about this. This is the most exciting thing of the podcast. I mean, say we want to say about the big, beautiful bill, but we have 3 deals we've done. We've done like 7 deals since November. 3 of them are in 2009, after 2019. So we go in, we take all the equipment in these manufacturing companies. I've got a guy touring the nation right now. This is another element people don't think about that they would never do alone. That's why I'm not worried about people stealing our theory, because I wouldn't wish my job on it. No, I'm kidding. Because there's a lot of guarantees, a lot of work, is just joking, but institutional. It's a lot of work. It's a bigger venture than we applied at the beginning. But I've got a guy now going company, and I call them cost seg nerds because they're taking every serial number, throwing it into chat, and we're taking like all the equipment, and my guys are getting 100% cost seg again. So negative K1s on year one. And then year two, I mean, our effective yields, even though they're at X, if you really are playing it straight down the tax row, guys are making, like 60, 70, 40, 30, 20. I mean, they're making really high yields on cost seg right now.
Yeah, it's an interesting space, especially because you've got you've got so much equipment to depreciate. All right, so I'm going to let you go. Obviously, a lot going on, but two more questions. One is, and we ask everybody this, you've been at this some time now, like what part of passive investing needs to die? And that's a funny question, but like just when you look at the idea of passive investing or the space as you see it writ large, what do you see that's not working that needs to go away?
Well, it is interesting because of aggregation, like Realty Mogul and some of the bigger brands, now they're only taking sponsors with like 500 million AUM, right? So there's an institutionalization of the crowd space. And I'm not saying this should die, but I'm just saying it's interesting for people to think about it. That's why they should continue to work with yourself is to find that space. I think you just have to be aware of are there people in the space that are institutionalizing the middle space that has all this magic in it for us emerging managers. What I did like about the fund launch guys is they were like, hey, you know what? We don't want this space to become we don't want everybody to sell out to Wall Street. We want to stay in this space, and we Americans want to bless other Americans. A little bit more work. Guys like you are exactly what the Gap has to have. And then we actually democratized and we kind of take back control from Blackstone, BlackRock, Vanguard, and State Street, and we stay in control. So I think you have to stay conscious in the space as the space starts to aggregate for a greater efficiency. Funds are okay, individual funds are okay, but are you losing the control you think you're gaining because you're tuning out on what's happening in the space? So I'd say the Wall Street approach to the middle market space, I wouldn't say it has to die, but I think we need to be very aware of where are we just becoming a cog in the wheel and tuning out.
Sure. Okay, that's a great answer. I haven't gotten that one yet. All right, last. Someone wants to find you. Where do they go?
dwgcapitalpartners.com. And that will get you to our website. It doesn't hold everything that we're doing, pretty facile, but it'd be an honor and a pleasure to meet new people. And I just put this out there as like, I'm doing this thing like if, we have a nice referral program as well. Yeah, I said, if anybody wants to throw together a dinner across the United States or a lunch, more than 10 people, we'd be glad to fly in and present and serve.
Awesome. All right. Thanks, Judd. Appreciate it.
Thank you so much. What a pleasure. I know, by the way, I want to say this last one. We worked until midnight last night, so I was a little verbose, but hopefully that's our passion. We have a passion about all the nuances here. So we love real estate. So we appreciate coming on the show and being able to share with you.
I think the passion came through.
Right on. Thanks.
All right, thanks.
Take care.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review because that's how other people find the show. Till next time, invest clearly.